Welcome back to strategiccorporateresearch.org. In this video, we're going to take an in-depth look at the income statement. We'll start by looking at its conceptual framework, move on to a simple example, and then dig into the income statement of Verizon to see if we can learn anything about the finances of this company. So let's get started. The income statement is also called a profit and loss statement. And that's because it shows the performance of a firm over a period of time, a year or a quarter. And that way it provides insights into the operation of a firm. And many accountants refer to an income statement as a moving picture of a firm. It shows what goes on over some period of time. The basic formula for an income statement is quite simple. It's simply revenue minus expenses equals income. But we simply don't leave it at that level. For example, even this notion of revenue can be more complex than it might seem. We typically think of revenue as the sales of a firm that they receive from a product or a service. But it also could be the inflow of resources. For example, it could be dividends from stock that they might own. Similarly, in terms of expenses, we typically think of normal business expenditures, but there could be other outflow of resources for licensing, patents, and so on. So it's important that we think broadly about both these two concepts. We also move on in the income statement to talk about gross profit. What's gross profit? Well, if we take revenue, let's come into a firm, and we subtract from it the costs of goods sold, COGS, we get the gross profit. So what's COGS? COGS are the materials, the labor costs, or anything directly involved in production. So for example, in the creation of an athletic shoe, there are materials and labor costs that go into making some very expensive running shoe. It doesn't include all the costs of doing business, which is why it's called gross profit. But you can also see from an accounting standpoint how it's important for a firm to calculate how much of their revenue are they spending directly on the production of an item or a service. So gross profit is a very useful concept. But moving down the income statement, we qualify it further, and we calculate the operating income. And what's operating income? Operating income is the gross profit. Oh, and you'll remember from the previous slide, gross profit is what? Revenue minus COGS will give us the gross profit. We're now going to subtract from gross profit sales, general, and administrative costs, and depreciation. And that will yield our operating income. What is SG&A? Sales costs, administrative costs, any management costs, all the other costs involved in production, but not directly involved as COGS were. Depreciation, again, is a very simple kind of calculation. It's a cost due to a wear and tear on a piece of equipment or facility. So you can see that operating income is a much more fine-tuned measure. It subtracts both COGS plus SG&A and depreciation. And oftentimes operating income is used to evaluate the performance of a firm. One final step. If we take operating income and subtract from it taxes, then we get net income. And net income is the bottom line of the income statement. So that's where that phrase comes. What's the bottom line? The bottom line is the bottom line of the income statement. And it's a common financial measure. Although sometimes people prefer operating income because it's not influenced by what a firm is paying in taxes. Firms can use complex strategies for dealing with taxes, so sometimes it's more important to look at the net income. Okay, let's look at a simple example. True story. I bought some equipment to produce a music CD. What would an income statement look like for my company? Well, revenue would be what I was paid for my sales of CDs. The COGS, what was directly involved in production, was the studio supplies, the studio musicians, and the manufacture of CDs, directly involved in production, which would yield the gross profit. SG&A, well, it could be our administrative staff person, of which we don't have, but if we had one, or CD giveaways or any sales would be part of SG&A. My accountant depreciates my studio equipment and my guitars on a regular basis. I know what that is. And that would yield our operating income. If you subtract the income tax that we pay on our vast CD sales, then that would yield our net income. So again, what you can see from the income statement, a pretty simple statement. You start at the top of the page with revenue and then make various deductions. And again, these are conceptually important: COGS, SG&A, depreciation, income tax, and then you end up at the bottom line with net income. Okay, let's look at a real example. Actual income statements are much more detailed, and categories are broken into many subcategories, and additional adjustments are made. And what we want to do is always begin by looking for these key concepts. So this is an income statement for Verizon. It comes from Yahoo Finance. What I want to do is just make a few notations on it so we can look at it a little more closely. First, let's look in red. First, you need to recognize that in most financial documents, numbers are reported in thousands, which means you need to add a comma and 3 zeros to all these figures. Secondly, we've got to just be a little careful of vocabulary here. Instead of COGS, they're calling it the cost of revenue. And instead of SG&A, they're calling it operating expenses, but the same basic concepts. I've used my highlighter to identify the key concepts we were looking at. First, at the top line is revenue. We have it for 17, 18, 19, and then the trailing 12 months. And we're actually just going to not look at that figure because it just increases too much complexity. So we'll look at 17, 18, and 19. And we can see the revenue went up from 126 to 130, and then up a little bit more to 131 over the past 3 years. COGS, again, looks similarly, went up a bit and actually then came down a little bit. So if you look at our gross profit, you can see the gross profit rose pretty steadily from 74 to 75 to 77. Now, when we get to SG&A, we notice something a little different, though, because we see that it's gone from 45 to 48 to 46. And what this translates to is, in terms of our operating income, it actually went down in 2018 and then back up in 2019. Looking down at income tax, we see something very interesting here. In 2017, we see a minus sign of $9 million here, which means that rather than paying income tax, they got either a refund or a deferral. And we can see that this is really important when we look at the net income at the bottom line. In 18 and 19, these were much more reasonable figures. So if we look at net income at the bottom of the page, in 2017, we say, wow, it's $30 billion. It dropped by half in 2018. Well, not necessarily, because if you actually look at the operating income, you'll not see that, because what we see here is the effect of this very large tax deferral. And then again, net income went up to 19 in 2019. So you can see the power of looking at a financial statement, and also not just looking at revenue, but looking at the net income, the bottom line at the bottom of the page, which is really what's important for us. And also understanding COGS, SG&A, and in this case, income taxes. So the income statement has its limitations. It only includes one kind of financial information. What it doesn't include, doesn't say anything about debt, doesn't say anything about buildings or equipment. It says nothing about stockholders. To get this information, we need to go to the balance sheet. I hope you found this summary of the income statement helpful to you, and you should now turn to our video on the balance sheet. Thank you.